Welcome to the video. Today we will decisively answer whether you should liquidate investments to eliminate high-interest debt. We will cover the 10% rule, why a 401k loan can be toxic at high rates, and a concrete debt avalanche strategy. It will also protect your emergency fund, show smart refinancing steps, and provide quick math examples. We will wrap with key takeaways and a couple of quizzes to test your understanding. Let's jump in. Here is our roadmap. First, why this topic matters. Next, a quick disclaimer. Then we will explain the 10% rule and why debt elimination often beats investing when interest rates are high. After that, we will detail the debt avalanche strategy, discuss protecting your emergency fund, and outline refinancing tactics. Then we will run quick math and examples, do short quizzes, and finish with key takeaways. High income does not automatically create financial freedom if high-interest debt is draining your monthly cash flow. Eliminating expensive debt is akin to capturing a guaranteed return. Consequently, improving cash flow stability reduces stress and creates room for faster wealth building. With that context, let us move to a brief but important disclaimer. Before proceeding, please remember that this content is educational and not individualized financial advice. You should consult a qualified tax professional before selling assets, because capital gains taxes and timing matter. Additionally, verify your employer plan rules for 401k loans, as job loss may trigger immediate repayment and potential taxes and penalties. Because interest rates, refinancing options, and personal risk tolerance vary, you must tailor decisions to your circumstances. With that said, let us proceed to the core principle of today's strategy. Here is the brutal math. If your debt interest rate exceeds your realistic investment return, prioritize debt elimination. For example, paying 10.5% interest while expecting a 10% market return produces a negative spread even before accounting for volatility and sequence of returns risk. In addition, a 401k loan carries a toxic feature. If you lose your job, you may have to repay the outstanding balance immediately or face taxes and penalties. By eliminating high-interest debt, you capture a guaranteed return equal to the interest you avoid. As a result, it typically outperforms speculative market gains when rates are high. Now, let us lay out the debt avalanche game plan. This flowchart illustrates the debt avalanche sequence. First, you maintain a 6-month emergency fund. Next, you list all debts with their APRs and minimum payments. If any debt exceeds 10%, you prioritize paying it off immediately, even by liquidating non-retirement brokerage assets after considering capital gains. After clearing that debt, you reassess and repeat. If no debt is above 10%, you move to the 7 to 10% band. In that zone, you both attack balances and consider refinancing to secure lower interest rates and lower monthly payments, then redirect the freed cash flow to the next highest APR. If there are no debts in that band, evaluate the 6 to 7% range and pay down as appropriate while monitoring refinancing options. Once all debts are below 6%, you can shift toward balanced investing while continuing targeted payoff. Throughout, you do not touch your emergency fund. Prioritize eliminating 401k loans above 10%, automate payments, and review progress monthly. Here is your step-by-step plan. First, inventory every debt with balance, APR, minimum payment, and term. Second, protect your 6-month emergency fund in a high-yield savings account. Third, liquidate non-retirement brokerage assets if necessary to eliminate debts above 10% while considering capital gains. Fourth, target the highest APR first and pay minimums on the remaining debts. Fifth, automate payments and consider weekly micropayments to reduce interest accrual. Sixth, refinance debts in the 6.5% to 9% range to materially lower rates and monthly payments. Seventh, redirect the freed cash flow immediately to the next highest APR. Finally, review progress monthly and avoid new consumer debt until your foundation is solid. Next, let us lock in the importance of your emergency fund. Your emergency fund is a shock absorber, not an investment. Keep about 6 months of essential expenses in a high-yield savings account, prioritizing accessibility and safety over marginal yield. Do not use the emergency fund to pay down debt unless the rates are catastrophic and you still maintain a sufficient buffer. This liquidity prevents you from falling back into high-interest debt when unexpected expenses arise. With the base protected, let us explore the refinancing sequence to unlock cash flow. This sequence diagram shows the refinancing path. The borrower gathers credit information and documentation, requests quotes from multiple lenders, and compares APRs, fees, and monthly payments. The borrower then selects the offer that improves cash flow stability, locks the rate, and moves through appraisal and underwriting. At closing, the old lender is paid off, and the new monthly payment begins at a lower amount. Immediately, the borrower redirects the payment savings to extra principal on the next highest APR debt. Throughout the process, pay attention to timing risk and rate lock expiration. This table illustrates a sample debt inventory. It includes a 401k loan at 10.5%, a high-rate credit card, a home equity line of credit at 7.9%, an auto loan at 6.25%, and a brokerage ETF asset that could be liquidated if necessary. The strategy notes highlight prioritization and refinancing opportunities. Now, let us compare avalanche versus snowball approaches. Here is the comparison. The avalanche method targets the highest APR first, which mathematically minimizes total interest and maximizes the effective return on your dollars, especially when rates are high. It works best when you can maintain discipline. The snowball method targets the smallest balance first, creating early psychological wins that can improve adherence, but it usually costs more in interest. If motivation is your primary barrier, snowball can be a bridge into the avalanche approach. Let us anchor the numbers. The effective risk-free return from paying off debt equals the APR you avoid. Paying off a 10.5% loan yields a 10.5% guaranteed return. Apply a simple spread test. If your debt APR exceeds your expected investment return, eliminate the debt. For example, a 10.5% debt versus a 10% expected market return creates a negative spread even before considering volatility and taxes. Consider taxes before selling investments. If a $15,000 ETF position has a $3,000 gain at a 15% long-term capital gains rate, the tax would be approximately $450, leaving net proceeds of about $14,550. If using those proceeds eliminates a 10.5% debt, the annual interest saved is roughly $1,528, which still favors paying the debt. Finally, a 401k loan carries concentration risk. Job loss can force immediate repayment and potential taxes and penalties. Risk-adjusted, it is especially problematic when the rate is above 10%. Next, we will map a 6-month attack plan. This Gantt chart schedules your next 6 months. Preparation covers debt inventory and tax planning for any asset sales. Execution includes liquidating non-retirement assets if needed, paying off debts above 10%, and running the refinance process from application through closing. Acceleration starts once refinancing is complete, redirecting payment savings to the next highest APR, and automating weekly micropayments. Throughout all months, you maintain the 6-month emergency fund. Quiz time. You hold a 401k loan at 10.5%, while your taxable index fund is expected to earn approximately 10% this year. What is the most financially sound move, assuming you still keep a 6-month emergency fund? Option 1. Hold the investment and make only minimum loan payments. Option 2. Liquidate some or all of the taxable fund to eliminate the 401k loan after a tax check. Option 3. Borrow more from the 401k to invest more in the market. Option 4. Ignore the loan and add to the investment monthly. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to liquidate some or all of the taxable fund to eliminate the 401k loan after a tax check. Paying off a 10.5% loan is equivalent to earning a guaranteed 10.5% return, and reduces the job loss repayment risk baked into 401k loans. Second quiz. Should you use your full 6-month emergency fund to accelerate debt payoff if your highest APR is 9% and you have no backup liquidity? Option 1, yes, because 9% is high and payoff always wins. Option 2, no. Keep the emergency fund intact and find savings or refinance instead. Option 3, use half the emergency fund, then rebuild it later. Option 4, invest the emergency fund to try to beat 9% first. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to keep the emergency fund intact and find savings or refinances instead. The emergency fund protects your cash flow during shocks and prevents new debt cycles. Therefore, prioritize refinancing, expense reduction, and redirection of freed cash flow over spending your emergency reserves. Here are the key takeaways. If your debt APR exceeds your realistic investment return, eliminate the debt, especially above roughly 10%. High-rate 401k loans are risky because job loss can trigger immediate repayment. Use the debt avalanche approach while keeping your emergency fund intact, automating payments, and redirecting savings. Refinance to lower rates and monthly payments to free up cash flow and accelerate payoff. Stop playing defense by aggressively removing debt above 6 to 7%. Then rebuild investments. In summary, eliminate high-interest debt first to secure guaranteed returns. Preserve 6 months of liquidity to avoid new debt traps. Refinance strategically to amplify cash flow and accelerate payoff. Once your weighted average rate is below about 6%, you can balance investing with targeted payoff while safeguarding your financial resilience. Thanks for watching. If this was helpful, please like the video, share it with a friend, and subscribe for more practical strategies. In the comments, share your highest current APR and your next action step. Your insights may help someone else take decisive action.